However, due to the fact that land property rights in China are only 70 years old and the reform of state-owned enterprise property rights is not yet in place, the short-term behavior of foreign investment is relatively serious. For example, Goldman Sachs and Citigroup, which entered the Chinese real estate market in the early stages, have begun to sell their assets. As for whether capital can enter and exit quickly in China, it is understandable to first strengthen one's own strength and gradually open up capital projects. However, since the second half of last year, a large number of South Korean enterprises have illegally withdrawn, in addition to increasing production costs. According to a survey by the Korean Chamber of Commerce and Industry, South Korean enterprises not only have complicated liquidation procedures when withdrawing, but also need to supplement the payment of land use fees and reduced taxes. In addition, some local governments do not provide assistance, resulted in Korean companies leaving without saying goodbye. In fact, due to the fact that the illegally evacuated Korean enterprises are mainly concentrated in traditional labor-intensive industries with low technological content, high pollution, and high energy consumption, the inability to smoothly import and export funds is not conducive to China's elimination of backward foreign investment and industrial upgrading. Obviously, how to treat foreign investment is no longer just a matter of quantity or utilization, but also a safety issue of being utilized. This change in attitude is becoming the key point and starting point of the important dividing line between China's first 30 years of forced reform and transformational reform, and the next 30 years of opportunity reform and proactive reform. Now it seems that there is little chance that foreign investment will miss out on the great opportunities for development like a raging beast in a flood. It will trap the reform ideas, and the consequences of continuing to stay in the version of the first 30 years are even more incalculable. The end of the investment banking era. The fifth wave of the subprime mortgage crisis has hit. Does the 8-day period from September 14 to September 21, 2008 mark investment banking the demise of the line? Lehman went bankrupt. Merrill Lynch sold, and Goldman Sachs and Morgan Stanley became regulated banks. This is part of the most disastrous transformation of investment banks since the Glass-Steagall legislation in 1933 created them. In the future, familiar names such as bulk bucket, the label of a large investment bank, and elite investment bank in the United States, will need to be redefined, and year-end rankings will be revamped, while clients and management will need to adapt to new basic rules. However, despite these changes, if investment banks survive the current crisis, they may also exist as familiar faces within the new organization, and the effectiveness of the investment banking industry will also be enhanced. In a sense, there won't be much change. The company we see as an investment bank has become a large gold mine run comprehensive group. After Morgan Stanley merged with consumer finance company Tianhui in 1997, it was no longer an independent investment bank. After Goldman Sachs went public in 1999, it went beyond the scope of investment banking by expanding trading and principal investment activities. By 2007, less than 15% of its earnings before taxes came from investment banking. In fact, pure investment banks have long ceased to exist. Incorporating some well-known old brands into banks and redefining some other brands will hardly affect customer service or market share. As for the performance of investment banks, whether these financial groups align their business with other businesses is just a symbolic issue. However, the market turmoil will bring opportunities for other institutions to enter the investment banking business field. In recent years, the financial services of human capital companies, hedge funds, and investment banks are showing a convergence trend. Goldman Sachs, which has a private equity and hedge fund business, is no more like an investment bank than the acquiring company Blackstone. Blackstone also has consulting experts and alternative investment funds. The ambiguity of these differences has led alternative investment companies into the